in the US, the market for consumer credit in particular, but I think credit generally, is so competitive that it drives down the price of credit to where it's hard to make money. It's hard to have good gross profit or good contribution margin in the United States. Whereas in Latin America, if you stand up a lending business and you get it really up and going, you're going to make really good unit economics if you run that lending business well.
Hi, everyone, and welcome to La Frontera, a podcast dedicated to exploring the dynamic startup and venture capital ecosystem in Latin America and the innovators behind it all. We're your hosts, Cyrus and Tom. If you enjoy this conversation, we invite you to subscribe to our newsletter where we announce new episodes and share additional insights and resources for founders and investors alike. We'd also like to invite you to share this podcast with your friends and to leave a review on Spotify, Apple, or YouTube to help more people discover the show. We love hearing from our audience. You can connect with us on LinkedIn and Twitter by searching for La Frontera Podcast. All right, folks, welcome to another episode of La Frontera. We're your host, Cyrus.
Tom. That's new. You caught me off guard.
All right. I'll do it again.
Try again, yeah.
Right. Welcome to another episode of La Frontera. We're your host, Cyrus.
And Tom.
Today, we've got Andrew Endicott, co-founding partner at Gilgamesh Ventures and the former co-founder and president of Petal, a credit card company built to help folks with limited credit history get access to credit. Andrew, welcome to the podcast, and thank you so much for being here.
Yeah, thanks, guys. Excited to talk.
Amazing. Well, I'd love to touch a little bit more on your background, because obviously you have a background in accounting, finance, and law, and it seems like you were pretty much made to become a fintech founder. So we'd love to learn a little bit more about how that background came about and how that helped you as a founder.
Yeah, well, I certainly did not, pursue the whole way to get into fintech. That's for sure. There's a little more serendipity in it, in that's not, obvious in retrospect. Throughout my entire career and education, I like to combine things that are quantitative and qualitative, but I also like doing things where they're rigorous. And I thought that things like accounting and law kind of both do that. They satisfy both those conditions. Initially, we pursued accounting, and then finance, really, because it was a good way to ensure that you can get a job. That was the initial impetus. But as I continued, I really became fascinated with the logic and structure of the legal system, and that led me to eventually going to Harvard Law School and doing my tour of duty, my 3 years of legal education and the Socratic method and all that, which was really rewarding and great, and met a lot of great people. But I do think that fintech tends to attract people with kind of layers of skills. It tends to be a multi-layered business for the most part. There are exceptions, of course, but anytime you're dealing with the financial system, there's a lot of complexity. And complexity, I think, often favors people that can see things in multiple different ways, because you have to do that to be able to execute, to be able to understand what's actually happening. And so, I had this background, from the numbers of business and accounting and finance, and then the kind of the logic of the legal structure of society. I found they kind of led me into fintech, but I found after I'd been in it that those have been extremely helpful, not only to understand how things work, but to also see how things can be different. Understanding those things, I think, can allow a little more creativity sometimes than you'd think. But, as an investor, I've also noticed that a lot of the people we invest in, a lot of the people we meet, probably more than, your pure technology type companies, they're folks with more kind of layered backgrounds that tend to be attracted to fintech and also tend to succeed, I think, in fintech as well.
And why do you think that is? Why do you think that folks they're more layered tend to succeed in fintech compared to other startups?
I think it's an appreciation of complexity. I think or a kind of a fascination maybe with complexity, because there is a lot of complexity in fintech, particularly once you layer on top, kind of the regulatory requirements and consequences, the kind of the implications of risk as well are tremendous and drive so much of kind of the way that incumbent institutions work, that from the outside, if you really just like the kind of the first order answer to anything, you'll kind of get the wrong way of interpreting things. Whereas if you really enjoy digging in and figuring out how things work at their most basic level, you'll get different answers often. So I think that's why.
Yeah, I think there's something that a lot of folks don't appreciate about fintech is just how, I guess, how regulation heavy it is, and how much time you do need to dedicate towards compliance, legal, other risks, et cetera, compared to any other, AI SaaS startup that you might build out. And I feel like I saw that firsthand while working at Sunny Day Fund, where, you can't call yourself FDIC insured if you're not. And if you are, there's specific disclosures you have to write down, and everything is very rigid in terms of what you can and can't do. And you've seen a lot of fantastic failures within fintech with folks that did not follow that. So
yeah,
I guess
there's a little bit of a concept that I've definitely seen in different contexts. You hear about technical debt a lot as something that organizations accumulate because they take shortcuts with respect to their technical infrastructure. Something I've seen this a couple of places and talked about it for years is regulatory debt, where the things that you do early on in an organization is particularly common in fintech, but also present probably in other places that are more regulated, like health tech. They don't just go away. You'll have to deal with the consequences of those things you did later on a lot of the time. And so you'll have regulatory infractions in the first, 6 months of operating that can come back to haunt you, or just a way of doing something that wasn't really buttoned up. It's the not so good gift that keeps giving often. And, it is hard to balance doing things correctly for a fintech company with the need to do things quickly. And it is simply a fact that speed is the biggest asset of any small organization that's trying to grow and to become, trying to succeed. Speed is the thing that they really do have. They don't have a lot of other stuff. Maybe more of a blank slate. That's the other thing, where they don't have to tear down a bunch of ways of doing things to do a better way. But speed is critical. And you can just look at so many success stories in technology generally, but also in fintech, that speed really can be one of the most important things that leads to long-term success. And, I think you can look at the Brexes of the world and the Ramps of the world. They've been on a tear since very, very much the beginning. And it's hard that's very important. The short-term benefits of doing things right from a regulatory standpoint they're not as obvious. And so it's a very understandable thing that people will take shortcuts in early days. And sometimes you may have to, but you will often end up paying for it anyway in the long run. But it's a difficult tension starting.
It really is. So then my next question would be, how did you guys manage that at Petal with so many regulations, licenses, legal risks around like lending, credit cards, payments, et cetera? How did you guys do that as you were expanding within the United States?
Yeah, so I think we benefited from the fact that I was a lawyer. The co-founder Jason was also a lawyer. We'd gone to Harvard Law School together, and so practiced law for several years. We had quite a bit of sophistication, I think, for understanding this stuff from the outset. Without having to pay anybody to tell us how it worked. We didn't have to engage, advisors on it a lot of the time. It was a different environment. We started Petal in 2015, 2016, which was, that was really as the Obama era rules were really coming into effect. You'd had Dodd-Frank passed, I think in 2010, the creation of the CFPB, which, that now that that era may be over, I don't really know, but you had a lot of change that had occurred, and there'd been a lot of uncertainty that existed probably in from 2010 to 2014, how this stuff was going to work. And then you had kind of a gathering kind of clarity about how the financial system was actually going to work going forward, either through the Volcker rule for investment banks to kind of the ability to pay rules for mortgages, to all these things had begun to accumulate a little more certainty, as the kind of the decade reached its halfway point. And so we benefited starting Petal from the fact that there was more clarity than there was a couple of years before. It was also at the same time, it was a little bit of a harsher regulatory climate, I think, than today to start a fintech company. There'd been a lot of litigation and things like that pertaining to non-banks lending money. The partner banking model was under some pressure then that I think it's easier for partner banks and fintechs to operate today. Most of the time, there are exceptions to that. There's been some turbulence in the BaaS sector in the last 2 years with the things happening with Synapse and whatnot. But so this regulatory component was something you just had to pay attention to. If you wanted to get a platform off the ground to lend money, which we were doing with Petal on a credit card as the product, you had to convince partners to work with you. We ended up working with WebBank, which is a great institution. And all of these groups that are potential partners for you really wanted to understand what you're doing to make sure that your product is going to be compliant with law and does not create risks for them that are going to threaten their charter. So we focused on it. I think we created the product in a way, in addition, using cash flow underwriting as really one of the main differentiators of what we were doing, being able to underwrite credit to people who were new to credit, who had limited access, didn't have a lot of information at the bureau. We wanted to use bank account data to be able to underwrite that risk, creating kind of this thing that cash flow underwriting, which is much more talked about today. And my co-founder Jason runs Prism today, which kind of came out of the Petal kind of the Petal universe. And that now a lot of people are using cash flow underwriting tools to underwrite credit. But then it was not as common. It was more of a gray area from a regulatory standpoint. And this was one of our primary means of differentiation. So we had to focus on it. We had to really explain to different counterparties why and how it worked. And that now that's accepted, but it wasn't as clear then that it would.
How did you come up with it then? How did you guys figure out like that was the way to go?
Like so many things, ideas come from a lot of places. But when we were starting the company, the bank aggregation technology, which today we kind of call open banking, had kind of gotten started. So when I was a lawyer, I'd worked on the IPO of Yodlee, which is a company people don't talk about too much anymore, but that was a predecessor to Plaid. And Plaid was kind of really coming into being in the middle of the 2010s. It wasn't huge yet, but it was something. It was an important platform, important infrastructure. And it was just very clear that this gave you access to so much information that was previously not available unless you printed out, tens of millions of bank statements and scanned them, and you maybe used OCR to interpret them. Just the information that had become available to underwrite credit was much larger than it was before, whereas previously you only had credit bureaus. And credit bureaus only looked at a very narrow set of information for determining somebody's creditworthiness and somebody's financial health. This whole other world of, hey, does this person have a job? Does this person save money? How does this person spend their money? All these things completely unaddressed by FICO and by the bureau. And that's something that we I think just intuitively thought should be considered. You had this technology with Plaid and other providers coming into existence and being a real option to get this information. And it was pretty intuitive. This is something that you can use to underwrite somebody's risk, to understand whether they're going to be a good credit risk and they're going to be able to pay a loan back, or they're going to be able to pay a credit card balance back to you. That was one of the central, hypotheses that we started the company with. And we went from there, and over time, the evidence accumulated that it actually worked. And today it's acknowledged as working, with companies like Prism and others. And so, I think it's like so many things. You'll have foundational technologies which come out all the time that enable things that you wanted to do before, but you couldn't. You're seeing this with generative AI in so many different ways that, there's a meta example is you've got a bunch of unstructured data that previously people wanted to use for all kinds of stuff, but they couldn't. The machine learning, the data architecture, the means of ingesting that information were just not sufficiently good. But now you've got generative AI, which can tear through, unstructured data like nothing. And now you suddenly have all these things you previously wanted to do. You wanted to use all these documents to make decisions, to do things, and now you actually can. And so it's something that as an investor now I see all the time is you kind of just have to pay attention to understanding why things didn't work in the past. and understand why important changes enable you to do them now. Because if you pay attention to a vertical like fintech, and this is probably true in health tech as well, I'm sure with electronic medical records, this shows up all the time. It's kind of the big opportunities often are pretty clear, for things you want to do that if you were able to do something, it would be game changing. And you see people constantly try to do them, and they'll fail for very reasons that after the fact make sense. And then something will change, and somebody will try it again, and this time they'll actually have the capability to do it. And when you're an investor, that's an important question that a lot of investors ask: is why now? Which kind of, underlying that is like, somebody did this earlier and it didn't work. So why is it going to work this time when you try it? And so we're seeing the playing field for what ideas can be executed today shifting around in a very significant way, because generative AI is allowing a lot of stuff that couldn't work before. Stable coins are allowing a lot of things that couldn't work before. Agentic commerce, all these things they're just enabling a lot of things. And so a lot of business models maybe didn't use that people wanted to work that just couldn't work, maybe can now. Which is, when you're an investor, that's exciting, because it allows obviously good things to now happen when they previously couldn't.
And what was the business model specifically for financing that you guys use from day one, right? So setting up like a facility to get debt funding to then, be able to lend out to your credit card holders. Where were your first sources of capital? How did you structure everything? And I'm sure like the collateral that you were posting, how would you get like, your lenders to be comfortable with that if there wasn't a lot of credit history?
Sure. I've got a huge book on my bookshelf here. It's quite a large book, a lot of documents, a lot of complexity to all this, which is kind of a bigger takeaway from building any business dealing with credit, is that it's complicated. But there's kind of a formula for getting a lending company where you have to source your money's kind of inventory. You've got to find it somewhere so that you can then sell that money to somebody else for a fee, which is either interchange or interest or fees or something. There's a bit of a formula, in my opinion, on how these businesses are set up. You start with an idea and people, like any business. That's where every business starts usually. And if those people are sufficiently high caliber and the idea is good enough and interesting enough and attractive enough, they attract some initial capital from angel investors, pre-seed investors, whatever. They make some more progress, more capital arrives. They get some good team members that are great signaling, and then you have enough capital now to launch a product and to begin lending some of that money potentially to your initial customers. But you can't do very much of it, because equity is very scarce. It's very expensive. You're using it for other stuff. You don't want to use it to lend money because it's now just kind of dead weight on your balance sheet that earns a literally a capped rate of upside. Whereas money you spend on technology and other stuff has all kinds of upside. So you don't want to use equity. But what you do is you have to raise equity first to gain the confidence and the interest of lenders that what you're doing is real. It's been diligenced. Smart people that are writing checks have enough confidence in you to back you and take more risk than they're going to. And then the lenders look to that risk-taking behavior, and then they take a less risky position and give you a line of credit or a credit facility or whatever once you have that equity in place. So you have to get the equity first, usually, before you can get debt capital. And you have to have enough equity that it gives them enough confidence to really dive in. Because lenders, whether they're investment banks or private credit funds or whatever, their incentives are very different than equity investors. Let's say that they're going to make 20 investments over several years. They can literally get fired for one bad investment. So their whole incentive is to not make mistakes.
Yeah, so they have to be certain about the payout and their economics.
Exactly. And they want to see funding behind something. They want to see expertise behind something. They want to see other partners being blue chip and somebody that they can rely upon. And then they're going to ask for other things that guarantee that they're going to get paid back, like leverage, kind of structural conditions like advance rates and things like that ensure that they, even if things go south, they get their money back.
So I guess when you raised your first equity round, right, for Petal, number one, how much did you guys raise? And then how shortly after that did you guys go out and raise the debt facilities to be able to fund these purchases on the credit card itself? Like, what did that timing look like? What did that strategy look like?
Yeah, it took us a year to kind of have enough to really raise money to refine the idea, refine the strategy, which I think a lot of companies are like that. You just don't really know what you're doing for a while. You've got to kind of talk to enough people and see enough things and have enough conversations before what you're doing is solidified enough. So it took a year to get to that point, which maybe that doesn't count because there was no business before that. So we raised money not having a product out of the gate. We raised about $3.5 million. I think the post money was like 9.5, which pretty dilutive round. Basically sold a third of the company, and Charlie O'Donnell from Gilgamesh Ventures led that in 2016. And so we got that initial capital, and then we immediately started working on getting the debt capital to scale the business. We built a relationship with Jefferies, and built confidence with them over a pretty long period of time. And by the time that we were ready to launch the product, which was, I don't know, another year maybe, it took a while to stand up the business. At that point, we built that relationship with Jefferies, gotten term sheets signed, and put in place a credit facility so that when we launched the product, we could actually finance it. The debt capital needs of the business we built were probably heavier than a lot of than most fintech businesses, and even most lending fintech businesses, because the customers we acquired, the customers that we wanted were using the card. They would carry a balance often. And so there was really a loan made to them. Whereas some credit card companies, particularly kind of higher income targeting businesses, their customers don't carry balances. And so like the net amount of capital you end up having to hold on your balance sheet is lower for those businesses, surprisingly, than for somebody who is maybe not as high income and hasn't developed a track record of using credit. So we launched the product, we had the facility in place. And then after that, it's really the process of building these businesses is raising equity capital, raising debt capital, raising equity capital, raising debt capital. Ideally you kind of do it at the same time, but it's hard to do it at the same time because each of them want the other to be in place. So you often end up doing it in this kind of staggered fashion, which has disadvantages because you're always raising money, and there are just times in the world where you don't want to be raising money, like when Russia invades Ukraine. That was probably a bad couple weeks, for anybody who's raising any kind of capital. And when COVID happened, that was a bad time to raise capital. And this is just the nature of raising money, that there are times you don't want to do it, which ends up being one of the bigger risks of creating a business like this, is that you have kind of this capital risk that you need to raise capital at set intervals, and it may not be a good time to do it, which means if you need a deal real bad, you get a real bad deal, as Ben Pickens says, and that can really damage your business if you need to refinance or get something new, and it's just a really terrible time to do it.
Yeah. So kind of taking it back to the early days as well, something that I'm kind of curious about is in fintech, finance, et cetera, trust is huge, right? And so as you guys were raising this debt capital in kind of like a new market as well that you guys were creating, how did you build that trust with these investors to be able to give you these large credit facilities to do what you guys are doing?
Yeah, I mean, the part of it was really trying to speak their language. Like any sales in life is empathizing with your customer, right? And at the end of the day, a lot of things are sales, right? So really just kind of soaking in what they want and really understanding it and speaking to them the way they want to be spoken to, incorporating things they care about into your strategy, which if you're dealing with capital, that ends up mattering a lot, maybe not so much other things, but so that was the first thing. Relationships was another one. So we, throughout our existence, we made sure to surround ourselves with people that were really plugged into that world and could teach us and could, connect us with people. And so one of the earlier people we brought onto our team is a guy named Jerry Hampstead, and he kind of helped invent the credit card securitization a long time ago and been in this world for a very long time, done at a very high level. So we brought him onto our team as somebody who could really help build those relationships out of the gate. So kind of getting Sherpas to guide you up the mountain in a way is pretty important. And then I think that, like I said earlier, having equity investors Being able to illustrate to other folks that other people have given you a lot of money and trust you pays huge dividends. Anytime you're dealing with a kind of a trust critical business, capital is more important. I think that's just true. Insurance, banking, probably healthcare, things like that. It's hard to operate if you don't raise money. It's hard to bootstrap these businesses. You can do it, but it's very hard. It's a different path. It's a slower path. And the failure rate, I'm guessing, is higher. So, kind of having, blue chip partners that are known, that have written a big check to invest in you, that trust you, that can speak to those other partners you're trying to bring on board is really critical. And so I think that's the other big thing.
I mean, I'm interested to hear about after your whole, founding this business, eventually like exiting. Now you're on the investor side of things and you're looking at the US in fintech. And you're also looking at LATAM. I think you guys are about 50-50 at Gilgamesh. But I wanted to hear about your perspective now on the other side, looking at lending startups that are popping up like in Latin America, for instance, because that market is so huge. I mean, in some countries like Mexico, still the unbanked population is like 45% or something like that. And so there's a ton of people and businesses that can't get access to credit, that banks don't lend to them. And so you see all these startups popping up, and I'm sure you guys have reviewed and invested in a lot of them, but I want to hear kind of your perspective when you're reviewing, pitch deck or a founder that's trying to start one of these companies.
Yeah, I mean it's very different being on the other side of the table for sure. I would say it's significantly easier being on the other side of the table. An investor's job, I think Warren Buffett says this pretty well. I think you in any given year you've got to make a couple important decisions. If you do that, you've done a good job. That is so distant from a year in the life for a founder. They're having to make decisions every day, and with very incomplete information, with a lot of distraction, with not a lot of certainty that they're making the right call. So just fundamentally, what an investor is doing and what a founder is doing, they're very different jobs. And so that's one of the just a baseline thing. I think one of the things I've learned, I talked about complexity earlier. When you're an investor, it is very quite common for things when you're listening to a new idea or something, as the perceived complexity of something reaches a certain level, you just zone out. And so your job as a founder is to avoid that and to take, every business that operates in the world has a lot of nuance to it. Your job as a founder is to strip that nuance down to the most important stuff that you need to communicate to people and make it very simple and very clear what you're doing. Because if you don't, you undermine the confidence of the person you're asking to join the journey with you, that that it's a good idea, that you understand it, that you have confidence in it, and all these things. You don't want to end up in the too complicated pile when you're raising money. That's something I very much see more as an investor than I did as an entrepreneur. A lot of times when you're an entrepreneur, you kind of think that, illustrating that I know all this and that I have a very firm grasp of all these multivariate things, that's a good thing. But it's actually, you need to know all those things, but you shouldn't be talking about them. You should be talking about the absolute essentials of what you're doing, and make it feel inevitable that your strategy is going to work, and that these other considerations just aren't important.
You want the investor to basically be walking away to like, oh, I learned something, I understand this problem, right? So if you're going too deep inside the complexities and details, especially in fintech, because there are so many like niches that you can go in and so many complicated pieces of it, you can lose them.
Yeah, and that you want them to walk away having learned something, and that you want it to be a simple thing.
Yeah.
Controversial is good.
Sure.
Counterintuitive is good, not complicated. You want it to be like a logically very like 3 variable type thing, not like 10. Because you'll just lose them and they'll just start nodding their head and not asking questions, and that's not good.
I think that's so true about the whole journey as a founder, though. It's being able to be good at storytelling, which then also ties into like what you mentioned earlier about sales, right? Like storytelling is also related to sales. Is how do you get this, and how do you have your customer relate to like what you're building, and how do you mention it in a way where they say like, okay, that I understand what it is, and
I know that I need this. So
Yep.
I love
Now,
that.
humans are very, very narrative driven. It's not a good thing for the world necessarily. Like the world does not function on stories. Like the world is a very complicated place with lots of causes of different things, but that's not how humans think. We think of like people doing things, producing outcomes. That's how journalism works. That's how the media functions. That's how people think. It's how juries function. It's how politics works, and it's all wrong. It's like there's an H.L. Mencken quote. It's like for any complex phenomenon, there's an explanation that is simple, intuitive, and wrong. I think that's what the quote is, and it's just true. Like the world doesn't 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 function like the narratives make you think. But because of that, because of humans do require narratives, you as a leader, as a salesperson, the person producing the vision that is your organization, and convincing everybody to get on board with it, you got to be really good at creating those narratives, even if they you kind of skip through a lot of how things actually work. Um, so like, why is a customer going to like your product? You got to have a good story. Why are you going to make money? That story needs to be simple and make sense. Why will employees want to join this company? You want it to be quick and simple and not complicated.
And so then with like storytelling and Petal, as you guys are kind of growing, how did that story that you were telling and pitching to investors kind of like change over time? I want to talk about kind of your guys' growth.
Yeah. Yeah. I mean, so I said that storytelling is really important. And it always is. Storytelling in a funny way gets kind of harder as a company grows because when you're starting from the beginning, it's just a total blank slate. There's not many like facts you have to deal with. You're just telling the best story you can come up with about what you're doing while, telling the truth and communicating what you need to. And that's kind of companies at the point of inception. That's what they do. They're telling you, they're often using a metaphor for what they're going to do and trying to create this very clear, simple picture. Storytelling gets harder as a company matures because now you actually do have results that you need to talk about. So maybe the change that you wanted to be producing in consumer behavior is not obviously happening. Maybe the economic model that you're kind of really advocating is not clear that it functions the way you said it's going to, or the way you need it to. And so, what effective CEOs and founders do, and where they really, differentiate themselves and their ability to execute is they're able to kind of pull in those facts and those results and, the history of an organization, and they're able to make sense of it and confidently tell you a story about why they're going to succeed. Again, in a way that's simple and not too complicated and inspiring. And so that's how it mainly changes over time as when you're raising a Series B, by that point, you definitely need to have shown product market fit. You probably need to be showing like clear unit economics. Depending on what the markets are like at the time, you might need to be illustrating a path to profitability or proximity to profitability by that point. These things change depending on the market, but all these things are things that matter at a Series B, and not some of those stories are going to be easier to tell than others while adhering to the actual data. And as a company matures, investors look at the data and challenge the story a lot more. That is fundamentally the difference between kind of a venture investor and a growth investor. A growth investor is scrutinizing what you've done, and they're trying to make sense of it. They're trying to match it up with what you're saying. And so you have to maintain credibility. You have to actually say things that when somebody goes back and checks it, they're going to be verified. But the problem is sometimes those facts are not convenient for the journey that you're trying to advertise as, you're on. And so it's difficult, and some people are really good at it. They just have an knack for it. I don't know if it's something that I think it's something you can get better at. I'm not sure it's something you can, that if you're terrible at, you're going to be great at it someday, but it's really important.
So after Petal, you joined forces with Miguel to start Gilgamesh, right? I think I saw somewhere that Miguel was possibly an early investor in Petal, and that's how you guys met.
Miguel and I have known each other for quite a long time. We know each other for not quite 2 decades, but well over a decade, and have been friends for a very long time. And so you're right. He was an investor in Petal. And so I think that's how we started working together, initially. And that kind of got the wheels going. The idea around Gilgamesh is kind of one of the origin stories was that I think Petal was raising a Series C or something at the time. We were gearing up to do that, and we'd shown our board a deck about not every, but like a lot of companies as they're maturing. You like I said, you've got the story for what you've done up till now, and you need to tell this grand story of what's to come. And so often you'll end up having these kind of like, for lack of a better term, like kind of these slides in the deck later in the deck that are almost a little silly. Like we're going to launch 10 products and we're going to tackle, spread throughout the world, that kind of thing, and you end up doing some of those things. You never end up doing them all. And we got feedback like, hey, the additional products thing, that just doesn't seem credible. But the additional markets thing, hey, that actually does. You should develop that. And it might be something that later stage investors actually give you credit for. And so, we were looking at a bunch of different markets, around the world, Canada, Mexico, whatever. And I remember I called Miguel and like, hey, can you help me kind of like build out this story? And so, Miguel and I ended up just having conversations with a lot of fintechs around the world at that point. And it was pretty spread out, but we specifically had conversations with two that we ended up to this day becoming really close with. So one was Clar in Mexico, which we ended up investing in. That was our first investment with Gilgamesh, and Banco Neon in Brazil, which we have a very close relationship with the founders of that today. And really the learning, kind of the part of the origin story where it kind of comes up is like, just like seeing, Gilgamesh, one of the things we do is we invest globally in fintech, and a lot of that's in Latin America, but generally just investing around the globe. And we just saw the growth rates, and it was just astounding. The ability of these companies to grow quickly, grow profitably was really surprising. And that was kind of a light bulb moment for me and Miguel. It's like, we got to be part of this, like all these companies growing so fast elsewhere, there's got to be some way for us to do it. Eventually that became Gilgamesh as we invest, in those businesses. And that's kind of how we do it. But I think it ties to something that we talked about earlier before we started, was lending in developing countries versus lending in the US, or lending in LATAM versus the US. It's a really interesting kind of thing to think about, because like so many things, I think the easier it is to do something, often the harder it is to succeed. And I think in the US, it's easier to start a lending company. It's harder to like, reach escape velocity, exit, kind of, produce the big outcome, because there's a lot of competition. There's a lot of capital. There's a lot of capital chasing these opportunities, and so on and so forth. Whereas in developing places in LATAM specifically, it's hard to set up, it's hard to get started in lending business. But once you're there, once you have it stood up and you've reached a certain critical kind of sustainability to it, you can really do marvelous. Nubank is the biggest example of this, but there's a lot of other examples too, that are out there. And so, and in lending in particular, the thing that's true in Latin America that's not true in the US is that if you set up a lending business in Latin America, you don't have to fight to make it profitable in the same way. In the US, the market for consumer credit in particular, but I think credit generally, is so competitive that it drives down the price of credit to where it's hard to make money. It's hard to have good gross profit or good contribution margin in the United States. Whereas in Latin America, if you stand up a lending business and you get it really up and going, you're going to make really good unit economics if you run that lending business well. It's just not as hard to do it. Now, you're going to have a lot of problems. You're going to have a lot of fraud. You're going to have probably higher loss rates for any given asset class in Latin America than you do in the United States, because there's just a general affluence difference, and affluent people don't default on their debts as much. But once you strip that out, you're still making more money in Latin America generally. And that has huge consequences. That means your growth is profitable. That means your payback periods are faster. It means if you put $1 out to acquire customers, you're going to see that dollar back in your bottom line much more quickly. So that's what we kind of saw, when Miguel and I were looking originally at these businesses, and Clar and Neon and others. It's like, wow, like you're growing very fast, but at the same time, it's not like stupid growth. You're not losing money. You're not running a negative gross margin business to grow, which it feels like every big cycle in the United States, this just ends up being the story is like companies grow and you're hearing it right now for a lot of the infrastructure Gen AI is like, are these negative gross margins? For $1 of revenue, how much do they actually get to keep? Before fixed costs. And every time that there's a lot of fast growth in the US, it ends up being a problem. It's less of a problem in a developing economy because there's less capitalized competition because there's not as much capital in the first place funding new businesses in those markets.
Yeah. What's funny is I remember we hit a period here in the United States where there was a huge focus on unit economics as startups and focusing on profitability from the get-go. And then you had like the massive funding rounds with these Gen AI companies. I feel like that narrative around unit economics just kind of like flew out the window.
Every market cycle is different. And the expression is like history never repeats itself, but it certainly rhymes. I think that's very true in markets is like, every time there's a big change, there's somebody that says this time is different. And it is in some ways, but there's a lot of the same kind of things that lead the market to then come down end up also being the case. And I don't claim to know kind of what the margin structure of generative AI companies looks like, but it's probably a little more complicated than it just people have been assuming. And that's one of the things that people are looking at. And it's just it is generally true of a lot of businesses that the growth ends up being expensive, and great companies find ways to make it worthwhile. Companies that don't succeed, often that growth kills them.
You mentioned them a couple times, Clar. So they recently just raised like $190 million round. So big round, Series C. Can you talk about kind of like the story of you guys in investing in them, or at least dig a little bit more into that? Because it sounded like it was like kind of at the beginning when you're kind of getting comfortable and learning a little bit more about the ecosystem in LATAM and kind of like the opportunities there.
Sure. So it's interesting. Like I said, it was the first thing we did. At this time, it was like Gilgamesh didn't really exist. This was kind of Miguel and I, kind of seeing an opportunity and starting to put something together. So it happened really kind of post COVID. After COVID hit, I mentioned earlier, there's times where you need capital and capital markets are not very good. That was one of those times. Now, several months later, it was great. So it reversed. But COVID had hit, everything ground to a halt. Everybody went into their houses and didn't leave anymore. And Clar, I think, I don't remember exactly what the details were, but they either wanted or they needed to raise some capital. And the business had been growing wonderfully. And we saw an opportunity to kind of help them be part of doing that. And so we ended up, this is before we even had a fund, we raised an SPV and invested, we raised capital in our network and invested directly in Clar. And we used the Gilgamesh, kind of brand. That's the first time we used it, and invested. And I don't remember what the valuation and all that stuff was, but it was kind of it was one of these instances where opportunities happen when other things are challenged often. And it was a temporarily very bad fundraising environment. Yet we felt we had access to capital, and which we did, and we weren't a fund, and we didn't have a name, the blue chip name as investors that people would want. But when things are not as rosy, nobody cares, and so we were able to join them at that point, and ended up being really, really great investment for us. And they've continued to grow very fast, and the business is really thriving. It was a good one to start with, for sure.
Yeah, I have two follow-ups. One is like on the general kind of like market for lending companies in LATAM. Like we've kind of talked about, like the opportunity is huge, right? And they can grow extremely quickly and their economics look good. But then what about like their access to capital to then go ahead and lend out, right? Like that, the capital markets are far less liquid there. And then if I'm thinking about the economics of a lending company, like a credit facility or something from the US, for them, like a lot of the times, maybe it doesn't make as much sense to go into emerging markets because they're lending it maybe around the same interest rate as they are like in the US, something like that. And then there's a currency difference, like obviously like different risks you have to take into consideration. So I do kind of think about that, like when you're talking to the Clar guys or other startups that you're evaluating, like what's kind of going to back you up?
Right.
That's the question.
Yeah, we invested in a good number of lending companies in LATAM. Zeppelin is another one. They're a platform lending, but it ends up creating a lot of revenue. You're right. Setting up a company that has a balance sheet in LATAM is hard and it's different. So first of all, you've got to get, like I said, there's the formula. You got to get equity capital. Then you start with the good ideas, good people. You get equity capital, then you get debt capital. The equity capital generally is more scarce in LATAM, and so that's first and foremost just an obstacle for a lot of people. That you're not going to be able to establish the debt capital if you don't have equity. And so that's a hurdle that knocks a lot of people out right there. And then once you get to the point where you're trying to build this business and to finance it in a way that makes sense, you have other complexities that you don't have in the US. So the biggest one is FX, foreign exchange and currencies. There's two ways to do it. Most of the time, just from a kind of the fundamentals of running a business, it's better to raise capital in your local currency. So if you're lending in Brazil, you want to borrow Brazilian reais to lend out. And that way you don't have to worry about the fact that if the Brazilian real devalues, that it's going to be harder for you to pay off your lender.
Yeah, I think that's what I think it's Canastra. I think that's what they focus on is like just deals, lending like within Brazil.
Right. Exactly. And so, for instance, Zeppelin, their balance sheet has changed and become more sophisticated over time. But when they started, they were sourcing their capital to lend out from, they launched in Chile and they had Chilean partners that provide the capital to. And so there was no FX problem at all, except for maybe the equity investors that are investing in a Chilean company. And they've since expanded into Mexico, and that model has evolved in different ways. The other way to do it is to raise capital outside of the country you're operating in, and people do this too. For the main reason that there's just more debt capital in the U.S. looking for opportunities.
Sure.
And so when you do that, you almost always have to hedge the foreign currency risk on the credit facility that you put in place. The lender's going to demand that, and that adds cost to it. I think this moves around, but I think usually it adds 200 to 500 basis points, so 2 to 5% to your borrowing costs to hedge it. Don't quote me on those numbers, but it's something like that.
Check your math.
Yeah, which is pretty sizable. I mean, that's like that's basically SOFR. That's basically your risk-free rate, and so you're assuming that you're borrowing at SOFR plus 5, which is not a bad deal, and then you add another 5, you're increasing your borrowing cost by 50%. And so that's a real cost. But sometimes that U.S. capital, before you hedge it, is cheap enough that it's still a better deal than what you're going to get in Brazil or Mexico or wherever. The kind of just the standard interest rate is just higher. And if you look at Brazil, the central bank, not risk-free, the central bank rate is in the teens. Whereas in the U.S., I think the Fed right now is like 4 or something. So there's a huge difference. And so that hedging very possibly may be smaller than kind of the difference between the interest rates. So that's the other way to do it.
Yeah.
There's no right way to do it. I think certain asset classes tend to go one way or the other. What we've generally found is I think business credit, tends to be more financed in local currency. Consumer is I think probably more frequently done using U.S. capital.
Yeah,
because the capital markets for U.S. consumer credit are huge. And so there's, I think, just more understanding. Consumer credit just ends up being a little less complicated or a little less nuanced. It's kind of more the same in different places. Than business credit can be wildly different in how it functions and the different liens and kind of structure of it.
Yeah, that's 100%. Yeah, that's right. Like just anecdotally at Voss, like the companies that we work with, setting up facilities, managing the servicing and everything, all the consumer companies like Eddie, for instance, in Colombia, Buy Now, Pay Later, they're financed by US, right? And I think it's part of it is maybe just like the loans are much more like shorter duration than like business loans. And so it's easier kind of like to manage the risk and for international investors to kind of like, or lenders to.
Sure. I think that's part of it. Also, part of it is I may be wrong about this, but like the US consumer credit market is really big. It's like super large institutions that are doing it. So like Chase and Amex and
Yeah.
all these things that are kind of the type of capital that's global. Whereas a lot of the business lending market in the US is either corporate bonds, which is kind of different. It's just a different world, or it's SMB lending, which is dominated by banks, like small banks, like community banks and stuff like that. So they're not going overseas to look for opportunities. Whereas, your ABS market, that's who's going to consume the consumer credit in the US. They may not be in the US in the first place. They may be in Japan. And so that Japanese investor who's normally putting their money to work and probably doing it a lot in US dollars is fine going and getting their opportunities somewhere else, just as long as they have foreign currency protection and good legal governance and stuff.
Yeah. So talking about investors, who are some investors that you admire, especially around like LATAM?
I could talk ad nauseum about this, but I think probably one of the best people that we work with is Marcelo Lima at Monashis in LATAM. And we've co-invested with them a lot with Marcelo. And he's just somebody that over now kind of the entirety of our existence with Gilgamesh, it's been such a consistently, just great experience working with him in terms of integrity, honesty, insightfulness. And I would say he's the person that I most enjoy working with.
His track record is pretty impressive as well while he's been at Monashis. So I love that. And then something that I also want to touch on that I think you mentioned prior to us having on the recording, and this is going to be a little bit more of like a shift, but something that I've been really curious about is you mentioned something about not giving equity to all employees at a startup. And I want to dive in a little bit more into that, because that's something that I feel like in recent days, it's been coming up more as a conversation piece, especially with what happened at like Windsurf. Recently, a lot of the employees were kind of like left in the dust after the founders and a couple engineers left, and then just like valuations tanked. And so a lot of folks have been trying to figure that out. And obviously with the talk about LATAM, in LATAM, equity is not typically offered off the bat, right? A lot of it's cash comp heavy. Just because also there's a trust aspect of like, do the employees trust that equity is going to be worth something in the future? So it was kind of curious to hear that from you. So I'd love to dive a little more into that and, what your thinking is on that.
So let me begin at a very high level. One of the most powerful things that you can have in an organization is for the people in the organization to feel like they have ownership of outcomes and to bear both the benefits and the downsides of those outcomes. And because of that, exposure to the performance of the business is, all other things being equal, an amazing thing in a company. And, I don't think it's possible to set up a business to where like none of the employees have kind of that type of exposure. You need if nothing else, the CEO of the company their outcome has to be dependent on how the company does. It's just not going to work well if they just get a high salary, and the shareholders are going to get a result they don't want if that happens. Stock options and equity comp can be amazing for employees. I mean, just a drive around nice neighborhoods in San Francisco will give you plenty of examples of why it's great. You've had it's been a wonderful kind of driver of upward mobility, I think, for people, particularly talented engineers and things like that. It's been fantastic for them to do that. So those are all the good things. I do think that the way that employee equity in the United States works is extremely problematic. I think that if you're going to solve one thing with it, I think the tax treatment of it has to change, because the tax treatment of employee equity leads to a lot of other structural choices that they're just bad. So the what I mean by that is the way that B3B and 409A rules work, and I won't get into all that stuff. They basically mean that the stock option that you give someone when you give them equity comp, effectively the strike price will be worth the value of that share. So if the strike price is equal to the value, ignoring some other things, the option does not have any inherent value. It's worth what you're going to pay for it. Now, if the value goes up, it's worth something. If the value goes down, it's not. It has like a negative value. And that part alone is bad. Because what ends up happening is when the way that stock options work, you're granted options and you only exercise them later. But you don't get to hold the options forever. The options have termination points at various kind of junctures, which are beyond the scope of me being able to explain it. But what ends up happening is that you'll have a company that is doing well, and you'll have an employee that leaves the company, and then they have a short window to exercise that option to actually get the benefit of their compensation package. And what that effectively means is that now when they've left a job, and a lot of times when people leave jobs, they don't have another job lined up. They have to cough up a significant amount of cash to buy a piece of equity where they're no longer at the company. They don't have information about how it's doing. They don't have any path to liquidity anytime soon, and they don't have any information. There's never, our employees who are exercising this stuff, are they given the information that you would need to make an investment decision? Because that's what you're doing. You're making an investment. If you were investing something in the stock market, you can pull the financials. Well, when you're exercising a stock option for a company, you're not given any financials, and so it's just not a good system. And in the core, it goes back to the fact that the tax system requires that it works like that, and it not requires, but it strongly encourages a much better system of just give employees equity. They have equity. They don't have to exercise it. It's just theirs. And then provide a path to allowing people to sell that equity in a realistic, timetable, even if it's smaller and like a lower valuation. Make it real comp, because comp that you can't turn into cash is not really comp. And so when I say that not everybody should get equity comp, it's not really about kind of preventing them from accessing this thing. That's actually not the point. The point is that the inability to understand it, the inability to actually use it properly, because there's a good chance you won't have cash, and just the other problems of it. It's not real compensation for most of the people joining a company where you don't really care as much about kind of them bearing the benefits and costs of the performance. I think a better system would be to actually just pay them higher salary and make it more cash heavy, so that that they're not having to make these decisions. And then if somebody's at the company for a long time, they get promoted, then they have the sophistication and the information and like all this stuff where they actually can realistically make good decisions and have a disposable income to exercise an option. That's kind of what I'm getting at. And there are other systems for how this works. There's a reason why the current system is dominant. I really look forward to a day in which people start innovating more with this stuff. Honestly, it feels like they're trying to innovate the other direction. Like kind of sometimes, like making vesting periods longer and like, cliffs longer, and doing things that are actually worse. And then with the recent thing with windsurf and cognition, all this stuff, I think it's just terrible. I think it sets a really bad precedent. It's bad it's not just bad for those employees. It's bad for the world of technology, because it inherently just undermines the confidence that when you get an option as compensation, that you're actually going to get the benefit of it. Because the way that those deals worked, if you're given equity in a company, you should have equity in the outcome. And that's not what happened. It's very unfair. I think there's reasons why it's happened the way that it does, relating to the antitrust laws and needing to license something as opposed to buy it, so you don't have antitrust review. But I think those are very bad reasons. I think that seems like a cop out. And I think that I really do hope that there are further developments that prevent that from happening more often, because it's unfair, and it's going to be negative for company formation and attracting talent. Because if you screw people enough, they don't want to be part of it.
No, that's so true. I think one model that I've really liked and that I've personally benefited from is issuing, I believe, RSAs, where you're awarding equity directly in the company without having them to put up money to buy the options, essentially. And I've seen that happen at a few other startups, but it's pretty rare. It's a pretty rare model. You don't really see that too often. But
and it's very and I'm not sure if RSAs are the same as RSUs. These things get really complicated. The later stage companies do things differently. As you're approaching an IPO, you'll get what effectively is just common stock. and then they'll just pay the taxes for you. And I think that's the alternative to me, is just give people stock and just the company pays the taxes. That's how
I
it
like
should
that.
work. And it's actually more employee friendly, but nobody cares about getting the cash from exercising options. Like it's not important. Just give people less equity and just give them the equity, and then pay the incremental cash, which is not going to be tremendously. The company can afford it. Usually, even though companies don't have huge amounts of money, they have more money than individuals. And I think that's a better system. And it sounds kind of like what you're saying and how it works.
Yeah, exactly. So I think when I first joined that one company, a Sandy fund, I essentially got a certain percentage of equity, and that's how it was assigned to me. So now in my Carter, I just have like X amount of like units, stock units, essentially assigned to me, and that's it. Yeah, and
I
then
think you, I think you do see though a little bit of a shift though, at least like me sort of graduating from my MBA, like I see a lot of my classmates joining startups that are they're able to negotiate like a higher sort of cash comp, at least now. So startups are kind of realizing they need to be a little bit more competitive on that side. But then you really do have to be savvy though, to be like negotiating the equity piece to make sure that, maybe it's getting added on, like performance incentives, like that type of thing. And making sure there are certain clauses that are included to protect you.
Yeah.
It's hard if you're like coming out of college, you've never worked for a startup, you have no idea how these things work, right?
Yeah. My biggest problem is the information.
Yeah,
You have to make a decision very fast with a meaningful amount of money for most people on zero information. And that's just not how it should work. Like for a financially important decision, there are very few financially important decisions of that nature in life where the information is so poor. And that's what I think
yeah.
should change.
I want to shift to kind of close out here, to something a little bit less impending and serious. Just like kind of how do you disconnect, right? So you've been in New York for a while now. Talk about getting some fresh air, taking trips, getting away from the screen. What are some ways that you kind of like disconnect?
Yeah. Yeah. I don't like screens. I'm not a
Me neither.
fan.
They've destroyed my eyes.
I just think that there's a direct relationship between time not at a screen and you being in like a happy kind of mental frame. So I really believe in that. It's not something I used to do so much like 10 years ago, but today it's actually really important to me. I really believe in getting outside, and like I really enjoy the outdoors. I aspire someday to be like a really great outdoorsman. I'm not sure I'm there yet, but I enjoy fishing, I enjoy hunting, I enjoy hiking, growing food, things like that. Those things I think kind of, you know, maintaining connection to like the actual world is increasingly hard in our technified era where you're just surrounded by technology of some sort that does everything for you, and you can kind of zombie your way through life if you kind of don't try not to. And so I really believe in that. I think it's good for all kinds of dimensions of health. I really enjoy reading. I think people read less than they did 10 years ago. That's a bigger topic, around kind of like what smartphones and other things do to your attention span, and Gen AI very likely seems that it is making it markedly worse, which I think is really sad.
Yeah.
And I really believe in resisting that, and I try to read pretty. I've gotten to the point I don't try to read. I enjoy reading, so like I read relatively constantly. I read every day. I really enjoy nonfiction, but I read fiction as well. Always the actual physical copy. I've got, this is a good one, the Paul Volcker biography. It's kind of relevant these days.
Yeah.
I borrowed that one from my friend Patricia, but but I believe in reading. It's almost meditative in a way where concentrating on one thing, you have to concentrate to read. And that concentration, I think, is generally positive in the same way that getting away from a screen generally is positive. And then like most people, I enjoy traveling some. That's fun. I do a lot of traveling for work. So like my desire to travel has changed a little bit. It's more, not so much like go to Paris, but which I've been to once, very, very long time ago, but the more like go somewhere where it's natural beauty and things like that. And so yeah,
Yeah,
that's how I enjoy spending my time.
yeah. You recently took a trip to the Wind River Range in Wyoming, right?
Yes, yes. So
Yeah.
I went with my longtime very good friend Bert Hicks, who he and I have known each other for a really really long time, since second grade. And
Oh wow.
he and I, just by ourselves, went on a trip to the Wind River Range, which is most of it's in the Shoshone Reservation. I'm in Wyoming, extremely isolated, saw very few people over the 11, 12 days we were there, and experienced just some of the coolest um, just conditions of being outside I've ever experienced. The experienced a lightning snowstorm thing, which was pretty scary, but also pretty interesting in July to do that. And it was a step above thunder snow, which I've experienced thunder snow in New York. I've never experienced lightning snow in New York. But yeah, it's did experience things like that, and also just kind of unplugged for a pretty extended period of time, which was really good.
Were you guys hiking, backpacking? Like, what were you guys up to there?
Backpacking. So we uh we we carried, each of us, about 60 pounds of gear, including all the food we needed for the entire time, except for the fish we could catch, which we did end up catching a good amount of fish. So it was pretty athletically rigorous. Getting up to 12,000 plus feet, carrying 60 pounds, it's not fun.
Yeah.
Yeah.
There's
Thanks.
I was just gonna say, it was like, it kind of reminds me, there's a book that you should definitely read then, since you like the outdoors and reading. It's one that I'm reading right now and I've loved it, but it's by Leif Whitaker. He's like the son of Jim Whitaker, who like summited Mount Everest. He's like one of the famous like American mountaineers, but it's called
Yeah.
My Old Man in the Mountain. And I actually picked it up while I was at Rainier National Park in Seattle, recently doing some hiking myself. But I really love it. It's like a memoir, and it talks about essentially Leif's like life, and like some stuff that his dad has done. But yeah, I think you'd really enjoy that book.
I wrote it down.
Yeah.
I'll check it out for sure.
Cool, man. Well, yeah. What are you reading now? And like, what do you recommend beyond the biography on Paul Volcker?
Yeah, I've been reading more nonfiction the last couple weeks. I just finished a history of engineering in the Spanish Empire. There's a bit of a weird topic.
Where'd you come across that?
Yeah,
That's
so I have a strange way of sourcing. I've always sourced the books I read through relatively kind of just ways that I've developed. I pretty frequently read the Wall Street Journal books review. It's every week on Saturdays they release it. I actually read the paper version of it because you can just go somewhere and have coffee, and it's actually really you end up reading about a lot of books you don't end up reading, but you still understand what the books are about. But I end up buying a lot of books on that, which I think is the point of it. I think that it's a good way to market a book. But so I that's where I got the Spanish Empire book, engineering, which was really fascinating. And then right now it's actually really similar. I'm reading a book by David McCullough, who's the pretty famous biographer, did like John Adams and Harry Truman biographies. But he wrote a history of the Panama Canal. And I'm like 100 pages into it. It's like 600 pages. And it's also about engineering and former Spanish Empire. I think it's pretty good so far. But favorite books, I mean, my favorite book probably ever was, I really like Anna Karenina by Tolstoy. I really like Brothers Karamazov by Dostoevsky. I like the Russian literature a lot. It's very good. And then anything that Hemingway wrote is typically just fantastic. So I the For Whom the Bell Tolls is a really good one. But all of his writing is spectacular. And John Steinbeck, that's another good one.
Quite the range. Dude, this has been an awesome conversation. I don't know if you remember this, but actually our first conversation was about like in 2022 was when I was like finishing up. I was working as a trader at Fannie Mae and getting a little bit more interested in Latin America, learning Spanish, and was interested in kind of like, investing in Latin America, about to do my MBA, and was connected to you. You're the first actually like VC that I ever like knowingly didn't really know what to say or ask. I was kind of asking for an internship, but didn't really know how to ask about it. But it's this is kind of a full circle moment for me after now I've, had experience in investing and also working in LATAM. So I'm really glad we got to make this
Well,
happen.
if there's any moral of that story, probably nobody should be intimidated to talk to VCs because they ultimately
Yeah.
don't really know that much. So the entrepreneurs know everything, not the investors. But yeah, absolutely, it's cool to kind of bring it full circle.
Thank you for tuning in to another episode of La Frontera. We hope you enjoyed the show. You can listen to more great conversations on our Spotify, as well as on your other favorite streaming platforms. You can find us online at lafronterapodcast.com, and make sure to subscribe to our newsletter for show notes and to stay in the loop for new content. Ciao for now.